Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from OB3 to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. PwC's Pillar 2 engine, powered by Beacon, is a game changer for Pillar 2 compliance, provision, and modeling calculations. Built on a graph system utilizing over 20 years of international tax technology, this cloud-based centralized rules engine is developed by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and is also available to license. On this week's episode of Cross-Border Tax Talks, we're back in Washington, D.C. in PwC's Policy on Demand studio, where I'm excited to have Wade Sutton back on the podcast. Wade is a principal and leads the international tax team in PwC's Washington National Tax Services practice. Wade, welcome back to the podcast.
Yeah, thanks for having me.
All right, so before we dive into OB3, the prior podcast I had Nita on, where we went through the inbound provisions, and I think if there's one thing that I learned as part of that podcast is that the inbound and the outbound provisions are all very interactive. We're going to bring that together today. But before we get into that, we're at the end of the summer here. We're recording this in August. Did you have any big summer plans? Do any fun things with the family? What did the Suttons do for holidays for the summers?
We did. So my mom had a big birthday, and to celebrate, we, meaning like my sister, my family, kids, took her to Italy. Went to Tuscany, did the villa, so had a fun time there. Learned how to drive a stick shift Fiat through tiny roads in small Italian cities, but it was a great trip.
Was automatic not an option, or did you just?
Like I have no idea why, but you know, in high school I had a stick shift, so I sort of like made do.
Oh yeah.
But it was pretty stressful.
Was it? I mean, I had a stick shift in high school as well. But I haven't done a stick shift in decades.
Yeah,
was it a difficult transition, or was it like riding a bike?
Yeah, it took me like an hour to figure out how to get into first gear. I was starting at stoplights from second. But,
all right.
You know.
Oh, that's how smooth your foot is. That
exactly.
You're not be able to stall that thing. So.
And we just didn't hit hills for that first hour too.
All right. Well, I will repeat what I told Nita. My ideal of a good summer holiday is frankly not getting on a plane and not going anywhere. Yeah. So I spent some time in St. Louis, hanging out with the family and avoiding airports and email, and it was very nice.
Good.
All right, so let's dive in. So to remind listeners, the One Big Beautiful Bill Act, which we're going to refer to as OB3, because I can't say that more than once, was signed into law by President Trump on July 4th, 2025, that extended permanently with modifications certain individual, business, and international tax provisions enacted as part of the 2017 TCJA that currently were set to change at the end of the year. The bill includes various revenue-raising measures, including changes to certain Inflation Reduction Act clean credits. We did cover some of those IRA credits with Nita. We're not going to get into that today, so if listeners are interested, we touched on that briefly. Today's podcast is going to focus on the international tax and other provisions relevant for U.S. multinationals investing outside the U.S., or our outbound podcast. Before we dive in, Wade, to the specific provisions, maybe let's start with the big picture. So there are a number of provisions in OB3 that can result in large cash tax savings. FDII, bonus depreciation, R&E expensing, which we'll unpack, a number of others. What are some of the collateral implications that U.S. MNCs need to think about before they start figuring out all of their cash tax savings?
Yeah. Well, it's funny. This has been a real theme so far in the first month after passage, where everybody was pretty excited about the big savings that were in the bill. I think some people saw this coming because they modeled before the legislation was passed. I think others sort of did that after the fact and are realizing, oh shoot, I'm now a CAMT taxpayer, or I have a beat problem, or I can't claim as many FTCs as I wanted to, or my FDII is lower. And I mean, the tax code right now is pretty complex, and it's like if you pull on one lever, there are chain reactions throughout other code provisions. And so people are, you know, the short version is they're finding out that in order to preserve permanent benefits or not erode the value of some of these attributes that they're getting, they're having to carve back or cut back on the tax benefits they could claim this year that they otherwise would. So like not claiming 174 R&E expensing as fast as they could.
And so maybe let's unpack that a little bit. We did talk about that with Nita, but specifically CAMT, because that's one that is raising its head as companies reduce their their taxable income. And one of the common thoughts is, well, CAMT has a permanent carry forward. It is effectively a temporary difference, right, where that CAMT tax liability can be used to offset future regular income tax liability. What are some of the challenges that you've been seeing?
Well, there are kind of two types of challenges. One is there are a lot of people that are going to be temporary CAMT taxpayers, and that's happening for the most part because as 174 takes all these amortized deductions that were deferred and potentially accelerates them into 2025, your regular tax is going to be a lot lower than your AFSI. So you're likely to owe CAMT, but that's a short-term blip. You get a credit carry forward. I think what folks are then finding out is that when you look at the ordering rules in Section 53, you have to work through all your regular tax liability and use your other tax credits before you can dip into CAMT. And so it's not quite just a timing matter. It is hard to dip into those CAMT credits in a lot of cases. Now, there are also some taxpayers that are going to be permanent CAMT taxpayers. So these are people that have lots and lots of FDII, so their income is going to be taxed below 15%. And they will never foreseeably be able to use those CAMT credits. And you're already seeing people starting to talk about VAs, which is crazy for an indefinitely lived tax attribute.
Yeah, it's certainly something to think about from a financial accounting perspective. All right, so let's maybe then go sort of unpack some of the specific provisions. And you've already mentioned 174 Cap A, and we're going to try to avoid using too many code sections or when we do, but that is the domestic research or experimental expenditure, so R&E for short. So talk about this. This was something we've talked about on a number of podcasts in the past. There were some beneficial provisions that came into TCJA that expired. And so what does the landscape now look like for R&E?
Yeah, so we are now back in a world where you can expense R&E, but only if it's domestic activities, right? And so I think originally there was a lot of talk on the Hill that all R&E was going to be expensible, but someone in the House, I think, realized, why are we doing this? Why do we want to subsidize foreign lab coats? This is all about making things in America, which, by the way, is kind of a bigger theme with OB3.
Yes, it is.
So right now, for current year expenses, you can expense them if you want, or you can elect to amortize them over various periods of time. For older expenses that were capitalized under prior law, you can elect, if you want to accelerate those into 2025 or split them into 25 and 26. That's one of the things where it's driving people into CAMT. It's causing FDII issues. FDDEI. I'm going to get used to the new acronyms eventually.
Me too. Yeah. So those are really it's for any of those R&E expenses that were capitalized after December 31st, 2021, and before 2025, before January 1st, 2025. So it's really 22, 23, 24. That's when there was all this uncertainty, and the question was that going to be retroactive? And so it's not really retroactive, but what it does give taxpayers the opportunity then to take those expenses, move those forward, and that's your point, that it can tank your taxable income, doesn't trigger you. Does it effectively trigger you into the CAMT?
And we're already seeing people going to the Hill, going to Treasury, saying, hey, you're taking back this benefit you were trying to give us with CAMT. Is there any way you can ameliorate that with like a bleed it in for CAMT purposes over a period? So we'll watch that space and see if anything happens.
And there is a dial for taxpayers they can elect what they could potentially capitalize, over 60 months or 10 years. So there is some you just got to do the modeling to figure out what makes the most sense for a taxpayer. All right, so let's briefly touch on 163J, which is our interest limitation rules. Nita covered that in the inbound section, the save the DA, but I thought it is worth mentioning here in the outbound, the changes with respect to Subpart F, GILTI, Section 78, gross up, and 956.
Yeah, so the DA's back, that's a big headline, but beneath that, I think for a lot of international practitioners, basically, all of those provisions you mentioned deal with income from CFCs, and you can't take any of that into account for your 163J limitation, which is kind of hard to explain as a policy rationale, and it creates some weird discontinuities. So for example, you are much better off now for getting foreign tax credits operating in branch form than you are through a CFC. Why? Because the branch's income shows up in your 163J limitation. If you can push debt into your CFCs, right? So you borrow at the CFC level instead of directly at the US, or you on-lend, That's a much more efficient structure because the interest income from that CFC is not carved out of your limitation. So I think you're already going to see certain people, particularly cash tax sensitive companies, that are going to try and structure around that issue to avoid a significant hit.
Yeah, and I think that's the big takeaway on this is that how taxpayers finance their CFCs now changes to be able to the fact that GILTI and Subpart F are no longer included. You now need to layer in like, well, what does this do to potentially 163J, and can you increase your interest expense limitation, for example, for on lending, which would seem to be a common way to deal with that particular issue.
Yeah, the challenge, by the way, is getting a foreign deduction for that interest expense.
Of course.
Yeah, that's easier said than done.
Right. And I was going to try to go this whole podcast and not mention Pillar 2, but obviously thinking through those issues.
I thought that was gone.
Yeah, well, we've still many more podcasts and obviously a lot to wait on the G7 agreement, but wanted to dispel the notion and make sure that listeners understand that you were being facetious there.
Yes, of course.
All right, I got it. All right, so the next one is FDII, so our foreign derived intangible income, which is now foreign derived deduction eligible income, which Nita reminded me, well, it's not really based on intangibles. So now instead of FDII, it's FDII. I also, Wade made the comment, well, they didn't change the acronym for BEAT, but they did for GILTI and FDII. But let's talk about FDII or FDII, or you can call it really whatever you want. What are those big changes? And there are some really significant changes.
Yeah, so I think the biggest one is probably just we now have a permanent rate. So people can make planning decisions about where to locate IP, manufacturing, yada, yada, without having to worry about expiration or policy change in the future. And I think that certainty is going to drive a lot of behaviors. We're already starting to see people think a lot about moving IP back to the US. That's another trend we're seeing out of OB3. So that rate, 14%.
14%.
The other significant change, why did they drop the word intangible? Well, because you no longer have Q-buy or a deemed return that limits your ability to claim FDII, right? And that's causing a lot of people to have a lot more FDII. And as we started the show talking about, that's creating some CAMT issues. But overall, that's a great thing for people that particularly have IP in the US and are exporters, or people that invest in a lot of heavy tangible equipment and couldn't claim FDII before. Mm-hmm. Another big change is certain sorts of assets. If you sell them, you cannot claim FDII on that anymore. So it used to be if I transferred IP outbound, I sold it as part of a cost share, or 367D kicked in, and try not to use code sections, you could claim FDII on that. That's no longer the case. You have to own the IP in the US, and if you lease it abroad or license it, that is still okay. So I think that sort of continues the trend of we want you to make things in America with FDII.
And then what about expense apportionment?
Oh yeah, that's a big one. I should have started with that one. So next year, interest in R&E will not be allocated to FDII, and so that's pretty important. And it creates, on the R&D points, a pretty interesting arbitrage, perhaps you might call it. The FDII income is taxed at 14%, but because R&E activities that are directly related perhaps to that income are not treated as allocable to FDII, you can deduct them at 21%. Mm-hmm. So that's a very nice incentive to develop IP in the US. That kicks in next year for most taxpayers, as tax years beginning after 2025. So this is where accelerating that R&E expense under 174 that we just talked about can get you into trouble for FDII, right? Because it still counts for 2025.
Mm-hmm. Yeah. And then the deemed intangible income return.
Yeah, so that's gone. That's what's causing so many people to have a lot more FDII. Yeah.
And so particularly for those capital intensive businesses that had a lot of basis, that's certainly a welcome view for taxpayers. All right, so it's sort of the international sister, cousin relation to FDII is GILTI, which is now CFC tested income. Before we dive into the mechanics, how do you feel about the necktie as an acronym?
NICTI I can maybe
NICTI?
handle. I don't know.
You don't like necktie?
It's guilty to me. I'm going to be saying that for 30 years until like associates are like, what are you talking about? But yeah, necktie, NICTI, I don't know.
NCTI. All right.
Yeah.
So talk about that. What are some of the What are some of those changes? Very similar kind of to FDII, but what should taxpayers?
Yeah. So again, the word intangible is now out of the acronym. Why? Because there's no more deemed return. In this case, it gave you an exemption from GILTI for tangible assets. So that's gone. People will be fully taxed on all of their tested income.
14% rate.
14% rate, that's also permanent, so matches FDII. That's with foreign tax credits.
Right.
Importantly, you used to have a 20% haircut under GILTI. It's now a 10% haircut, and so that's how you get to the math of 14% when you lose 10% of your credits. And then on the expense apportionment side, it's almost the same as FDII, except FDII. You don't allocate interest, R&E, or other indirectly allocable expenses. And it's that piece that has a lot of people just scratching their heads because we don't quite, the whole directly allocable concept is not a well understood term.
So it says direct or other directly allocable expenses.
Yeah, that's the only, directly allocable are the only things you allocate to GILTI other than some specified expenses. So we're trying to figure out what that means and what are indirectly allocable. There's not a lot of guidance or really history behind those terms. And so we think Treasury is going to have to fill in the blanks here. And a lot of debate about, is that meant to be narrow or is it going to cover a lot of things? Stewardship gets tossed around.
Oh, you know I was going to ask.
Yeah. Mike Urs, who recently retired, would be happy to know that stewardship is back in the limelight.
Yeah, and we talked about it as he was getting ready to retire on the podcast. And so I think that's really the one of the big ones of what about stewardship? Does stewardship go away as far as being apportioned against GILTI, or is that similar to interest and R&E where that would no longer be apportioned?
Yeah.
So one of the issues that we're seeing with a number of taxpayers is, a lot of taxpayers when they were operating in a high tax environment, looking at the high tax exception election. Does that still make sense in the new system? And really what I'm asking is about this code section that everybody loves to throw out, 904B4.
Oh, yeah.
So can you talk a little bit about that to try to put that into as layman's terms as that's possible about what are some of the factors that taxpayers need to think about in this new paradigm?
Yeah, I mean, 904B4, no, I can't explain that in layman's terms, but let's leave that alone. Right. The overall point, though, I think is fair that the incentives and the interactions have been tweaked ever so slightly. I think fewer people are going to make high tax elections. And why I think that is because foreign tax credits are now a little bit more valuable in the new system than an exemption. So for example, the rate's up to 14% versus 13 1/8, right? You don't have expense apportionment based on certain sorts of expenses, so that means you should have more limitation, and your haircut's smaller. So I think all of these little changes mean that a GILTI credit, NICTI, whatever you want to call it, is more valuable in 2026 than it was before.
Okay. All right, and so those are, I think, some of the big highlights. We had mentioned those before. There was also a provision on the sourcing of inventory sales for purposes of the FTC limitation.
Yeah, so just as a reminder, when TCJA was passed, there was a new provision 863B that basically said if you manufacture inventory and you sell it, like say you manufacture it in the US and you sell it somewhere else, like abroad, you will source that income based on the place of manufacture. And I think a lot of people immediately out of the gate said, what are you trying to incentivize here? Do you want to move manufacturing to other countries? Because that's the thumb you've put on the scale there. So I think perhaps in response to that criticism, this new provision says, to the extent that the sales profit is allocable to a foreign sales branch under 864 principles, then 50% of the total sales income, that's a cap, can be treated as foreign source income. So I think for a lot of folks that maybe have a limited risk distributor with some manufacturing activities, this is going to be a really welcome change where they need foreign tax credit limitation. Maybe the branch basket is a great example of a place this would help. A lot of people have excess credits there.
Right. Yeah, and I mean, I think that historically under even TCJA and pre-TCJA, for those taxpayers maybe that have all their IP in the US and that have limited risk distributors offshore, operating in a CFC form, it does sort of beg the question, well, does it make sense? Obviously, if you need the foreign tax credit utilization to potentially check those in, because operating in a CFC form, because this sale is not associated with an Office of Foreign Fixed Place of Business because it's in a CFC, wouldn't qualify. But if you check the box, it potentially could generate additional foreign source income for taxpayers.
Yeah.
Okay. Next one I want to move on to is Section 898 and the 1 month deferral rule. Maybe if you can remind folks, how does that rule work for the 11/30 year ends? I think we oftentimes refer to it for calendar year taxpayers, but what is Section 898 and what did OB3 do to it?
So 898 allowed you to have a CFC tax year end that ended a month before the majority U.S. shareholders' tax year end. And going way back in the sands of time, like that rule probably made sense because it was actually hard to get documents from the CFC to fill out a tax return.
You're going way back.
On time, yeah. You know, we're in the electronic internet age, and that's not an issue. And, you know, there's a lot of, I don't want to say mischief, but just like headaches created by that rule. You know, a lot of people had these 1 month deferrals. We're going to talk about look-through in a bit.
Yes, we are. Next, in fact.
Okay, well,
by design.
We'll mix them up.
That's fine.
So, you know, that used to expire fairly regularly. And so to get an extra 11 months of look-through, people would oftentimes elect the 1 month deferral so that they had a tax year that started before the relative applicability date. So anyway, there were a lot of these CFCs. That ability is now gone. So what happens? For a typical calendar year U.S. company with 1130 CFCs, that's the most frequent example, there's going to be a short taxable year, basically the month of December 2025.
For calendar year, yep.
And then that CFC will have to match its majority U.S. shareholders year. One of the open questions here is, okay, what happens to the foreign tax credits that accrue? So, you know, for example, if our little CFC has a 12/31 year end, it's going to have a lot of taxes that accrue.
For local purposes.
Yeah, for local purposes, yeah. It's going to have a lot of taxes that accrue in that little 1 month taxable year. So many, in fact, that it might drive it into a tested loss. So no one gets to claim those taxes. And so I think there's some regulatory authority for Treasury to spread those taxes amongst the periods, and we're kind of looking to see how they do that.
Yeah, and what is the effective date on this? And then when can we expect regulatory guidance for taxpayers that need to think about provisioning about how those taxes will get allocated? Because to your point, these can be material numbers. If you have a large CFC and all of a sudden, you know, the taxes accrue in 12/30 run, absent guidance, I think the rules tell us all of those taxes would accrue. So talk a little about that.
So yeah, that is 11/30/2025. You're going to have the natural year end, and then for 12/1 to 12/31/2025, you're going to have a short year if that's your fact pattern. So to your point, in theory, you could be filing a tax return in 3 or 4 months after that. And what do you do about that without guidance for figuring out how many taxes your CFC has deemed paid, and therefore you can claim as credits? I think that's going to cause a lot of delays, extension filings, and then just waiting around for guidance, which again, Treasury has 18 months to make that retroactive to enactment.
Right.
This might be, if I were guessing, a priority issue.
One would hope, and maybe a notice or something even before we'd get a reg package to sort of tell taxpayers this is what they need to be thinking about.
Exactly.
All right, and so you already alluded to this, but 954C6, and you know, Wade, we've been doing this a long time, and I go back, 15 years after C6 came in and then became expired, and so what is C6 and why is this so welcome? And you mentioned already the 11/30 year end sort of fix, or at least a 11-month extension, but talk a little bit about maybe the history of 954C6.
Yeah, so basically it's a provision that excludes from Subpart F income certain payments like royalties, dividends, interest, things of that nature, between related CFCs, as long as the income that's generating the payment is not, Subpart F income or other types. And it's been a really helpful provision to help people move cash around their structures or finance intercompany arrangements or activities. And I think it's sort of been deeply embedded. It's like check the box. That provision is just sort of deeply embedded in everyone's structures and kind of a key plank.
Yeah, to be able to get dividends, interest, move cash around a structure.
So it historically would always expire after a period of time because it was enacted through reconciliation provisions and was not a permanent provision. So you'd always end up with these year-end extension bills where oftentimes retroactively look-through was being extended. So you could go into a year not knowing whether look-through was going to exist. And that's just bad tax policy. Yeah. Like you can't plan with a time machine. You need to know what the rules are so you can plan your affairs. That is all gone, right? It is now permanent. We don't need to have that heart attack exercise every December. So it's good to move on from that.
Yeah, and for those public companies, I mean, they would have to accrue the subpart F on those intercompany CFC to CFC payments, knowing that it was very likely that later in the year it was going to get enacted, and then it would come off the books, obviously for public companies. But this one I'm particularly excited about.
Yeah.
It's something that I've dealt with my entire career as an international tax practitioner, and I view this as a huge victory. The permanent CFC look-through, I'm very excited about. All right. Next one, and we're not going to dive into some of the technical mechanics, but the 958B4, what's referred to as downward attribution. Without going into some of the technical mechanics, maybe you can help explain sort of why did this rule come in, and then what were the issues with it, and why did OB3 and how did OB3 change it?
So the fact pattern this was going after was a lot of companies moved from the U.S. to have a foreign parent inversions, right?
Yep.
And after that would happen under the old rules, if a U.S. person owned less than 50% of the stock and the rest was owned by a related foreign parent, that entity was not a CFC because you didn't attribute ownership from the foreign person down. So they got rid of the don't attribute rule to turn those decontrolled structures into CFCs. Problem was they did it in an incredibly broad way, such that, like just about every foreign entity, there was pretty good chance it was a CFC because there was some related U.S. entity in the structure. And it caused a lot of mischief, headaches, compliance nightmares. So anyway, what they have done in OB3 is they undid the deletion from TCJA, so no downward attribution from foreign peoples back. That's good. And they replaced it with this 951 Cap B that's really targeted narrowly at the original evil it was trying to go after.
Right. Yeah, and I think this is a welcome change, particularly for inbound taxpayers that would stumble into this, that hadn't decontrolled or tried to reduce the CFC status. So this one I think is welcome change. The next one I want to talk about is Code Section 951A2B, and as you probably remember, I wrote this an article about this particular code section 15 years ago. Nobody talked about it for years, and it deals with what was referred to as the pro rata share rules for subpart F. And there is a new method, which we don't know, but maybe talk a little bit about 951A2B, which is where and how you determine subpart F for a U.S. shareholder.
Yeah, I have, unfortunately, a really long history with these issues because when I was over at Treasury,
I know
we
you
worked
do.
on the 245 Cap A regs. Don't send me hate mail. But, under the old subpart F pro rata share rules, I referred to it as the hot potato rule.
Yeah,
Whoever owned the CFC on the last day in the taxable year when it was a CFC, it got all the subpart F income. But there's another rule that said, well, if someone else got a dividend before that person owned it on that last day, then you should reduce the subpart F income that person's going to recognize. And people debate what the premise of that rule was. Maybe it was as long as that person got taxed on the income, it's not fair to double tax you on the same subpart F inclusion. Or maybe it's just like a liquidity point. If the cash is gone, you don't have it in the CFC to pay tax on.
I think it was the former, and because this goes back to the original 1962, when this has been in the subpart F forever, since its inception.
Yeah, and so after TCJA, there's this new 245 Cap A deduction. People sort of realized, I can pay a dividend that's going to reduce the subpart F for GILTI inclusion over here, but it might not be taxable, right, because of the 245.
That's our 245 Cap A is effectively our participation exemption.
Yeah. And So anyway, that immediately was like a 5-alarm fire at the Treasury Department and the IRS, and they put out regulations to try to shut that down. What Congress has done here is they've basically taken a statute and said, you know what, we're going to change the way you allocate Subpart F, so we just don't even have to rely on the regulations to fix this. Now, you alluded to this, but the problem is the statute's incredibly vague.
Oh, yeah.
It's like almost like a necessary and proper standard. It just says, you figured out, Treasury, what the pro rata share of this Subpart F income is. And so we really don't know what the rules are yet. And I think this is one, there is a transition rule and then it goes live next year, where it's going to take a while for us to get guidance. And so people are going to do M&A deals, CFCs will change ownership.
Yeah.
And during that interim period, you're just going to have to guess at what you think the right Subpart F and GILTI allocation is.
I've said this before. I think that 951A2B is one of the most probably unrespected code provisions. Because to your point, like, listen, if you're doing a sale of a CFC, the acquirer needs to figure out what that Subpart F income. Maybe then they'll take a look at 951A2B and figure out, all right, was there a prior dividend distribution? Is that going to reduce the Subpart F? But to your point, this also applies on intercompany distributions, which led to this whole issue with the participation exemption and making a distribution and changing the U.S. shareholder. Just a very curious provision within Subpart F. And now with OB3, they said, hey, they're going to change the pro rata share rule, but we don't know how.
Yeah.
So is it going to be based on days or months or like how income is earned depending on each shareholder? But that, I think, is going to be another important one, particularly as companies think about filing tax returns, providing for those taxes. It's another one where we need guidance, maybe not as quite as important as the other one, to actually figure out how to calculate any Subpart F.
All right, so government listeners, if we have them, I'm sure we do. 898 and 951A. Those are our top priorities.
Those are very important for taxpayers.
Yeah.
Exactly. All right. So there were a number of also technical clarifications in the bill. Don't want to get into any of those details, but any common themes or any important issues that you think are relevant for listeners?
I mean, these were on everyone's wish list of, guys, you should really fix this. And there's a little bit of contentiousness around technical corrections. Republicans didn't let the Democrats have their ACA technical corrections. The same thing happened with TCJA. So now that the Republicans had both houses, they were able to fix all these glitches. Now, the interesting piece, though, is typically a technical correction would go back to the beginning enactment of the statute. That we're not sure if that happened here, right? There are a lot of provisions, like there was a change to the R&E Rule 174 that said there's no inference about how you should interpret prior law based on this change. There's not that sort of language around a lot of these technical items, technical corrections. And so it's unclear, if we should take an inference from that about the law was different before. And you see a lot of this. Okay, I'm going to get into one of these technical corrections. Like there's a bad cross-reference for certain base differences that tells you to treat that as allocable to the branch basket.
For purpose of foreign tax credits.
Yeah, sorry. Never made any sense, and people wrestled with, is that Scrivener's error? Do I have to follow what the literal statute says? And so now that question is sort of like amplified by the fact that it's been fixed and we didn't have this no inference language.
All right, so maybe to wrap things up, advice that you have for taxpayers, any big themes coming out of OB3?
Well, okay, this is a cliche, but it's 100% true, which is you really have to model. It goes back to the original point. We're just finding that you push on one thing and something else pops out, and it's just the interactions of all these code provisions are quite complex and interactive. So there's a lot of optimization there that I think people are realizing how much R&E deduction can I take this year before getting myself into FDII trouble? Do I have a better answer from a cash tax perspective or rate? A lot of variables to sort through.
Yeah, and maybe just to call one out, because we covered it a lot on the Inbound podcast, is BEAT. Right? Oh, yeah. That is not just relevant for inbound taxpayers, also relevant for U.S. taxpayers. So as U.S. taxpayers are doing the modeling, what are the potential BEAT implications? What are the CAMT implications? Thinking about the ability to be able to use those CAMT credits, with their permanent carry forward, this is complicated. This is complicated math, and I think even saying 3 or 4 dimensions, I'm not sure is enough. And so very important for U.S. taxpayers to model. I absolutely agree with that.
Yeah.
All right, Wade, always great talking to you. Thanks for coming on. And now we just have to wait for reg packages notices. And as we start to get those, we'll bring you back on to discuss.
All right. Thanks for having me, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Wade Sutton, International Tax Leader at PwC's Washington National Tax Services Practice. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.